Hey, Renter Retires, it's Adam Schroeder, and today I am once again joined by Zach Lemaster, the founder and CEO of Rent to Retirement. And we have got quite the topic for you. I think it's the topic, Zach, that I would dare say every single investor has their eye on in today's world, and that is the mortgage rates. So first off, welcome, and how are things going?
Going well, Adam. I mean, we're in a crazy real estate market as everyone is experiencing. Lots of dynamic stuff happening out there. 40-year high inflation. There's a lot of people that have capital that are looking to invest in real estate. Maybe they've been sitting on the sidelines. I don't know, but it's still a great opportunity. Now we're going to talk about a subject today that is on everyone's minds, and that's rising interest rates. What does that actually mean, and what does that mean for real estate today? And what does that mean for the future? I think there's this assumption out there, Adam, where as people see interest rates going up, they automatically assume, oh, that means prices must come down, that we're due for some sort of correction, which is not historically true. And so I think that's really what we're going to debunk today on what interest rates mean, what they mean for your strategy and evaluating properties, what they mean for the future real estate prices, and how you should be looking at interest rates long term. We always like to look at statistical data over time. I mean, that really allows you to conceptualize what has historically happened when interest rates have gone up. And I think the main point we're going to make, Adam, and you'll talk about this more specifically, is that prices don't go down, right? Interest rates are a reflection of a good economy and supporting that it's a good economy. And as you're going to speak about that, it actually means more money is being injected into the economy to allow the economy to continue to operate efficiently and effectively. And so I think this is something that we need to really hash out, because so many people are getting pushback on these interest rates, or they're afraid of taking action and investing simply because they say, okay, cash flow might be a little bit. Yes, that's true, but we'll talk about why not to focus on that so much. And they automatically assume, okay, maybe I'll wait for interest rates to potentially stabilize or for prices to come down to be more of a buyer's market, which is not actually the case. So, I mean, let's dive into this, Adam. I think this is a necessary topic, and let's go through some specific stats to showcase exactly what higher interest rates mean.
Yeah, well, first off, people, you want to know that this is so serious that Zach stepped away from a dance party to be here. So that's how serious he takes it. So yeah, so I wanted to go over. You sent me a video where they were saying kind of talking about the last few times that interest rates have gone up, and so got to thinking and thought, okay, well, let's go back to the mid 90s and see when interest rates really spiked. And so I went on to the St. Louis Federal Reserve website, and so I looked at the chart of interest rates, and I kind of marked the spots and the times when we saw significant rises, relatively speaking, over a short amount of time. So the first one was from the fourth quarter of 1993 to the fourth quarter of 1994. We saw rates go from 7.05% to 9.11%. Now, these are obviously 30-year fixed for owner occupied, because that's just what the data that they have. So we'll just look at that, because that's actually the vast majority of the home market is obviously owner occupied. So over that time, from the first quarter, so what I did is I got the quarters that it went up in interest rates, and then I just looked at the average home price the quarter following it. So for Q4 1993, I looked at the home value of Q1 1994, because I figured that would probably be when it actually kicked in a little bit. So first quarter of 1994, the average home value was 153,600. And by the end of that interest rate rise, which was the end of 1994, in the first quarter of 1995, home values were at 153.5. So it roughly stayed flat, did not drop, obviously didn't skyrocket. But the previous 12 months of that, which is what we're thinking of as, that was the time where everything was hot and needing to be cooled off, we saw a 4.5% increase for the year. So it was going on, and that happened. So then the next time that happened, interest rates increasing, was 1996. We saw the beginning of 1996, 7.27%. By the end of the third quarter, 1996, it had gone up to 8.15%. So almost a 1% jump, not that huge. But over those quarters, the average home price, so this wasn't even a full year, went up 3.6% from 166,000 to 171,000. And that 3.6% actually beat the preceding year from that went from 156.1 to 169. So we're seeing, that one actually beat what was happening before that. And then we saw another one come around, and I'll pause after this one. But this was from the fourth quarter of 1998. It was 6.76% interest rate into the second quarter of 2000 when we had an 8.32% interest rate. And the median home value went up from 189.1 to 202.4. And so that was a 7% increase in home sale price. And the previous 12 months had seen a 5.5% increase. So you're seeing over time here, rising interest rates do not slow down necessarily home prices across the country.
And I think that you have a lot more statistical information to share with us, Adam, maybe because you just threw out a lot of numbers, you know what I mean? And that's kind of a little bit hard to follow if not, say, looking at a visual aid or graph. So maybe you can just briefly run through those other years here in a sec, just talking about interest rate increase and then what we saw in appreciation. Basically, what I'm hearing from you is that previously when we're looking at all points in history for the past 40 years or whatever, when interest rates are increasing, so are home prices. And actually, in many instances, home prices are appreciating and increasing above what they did the year preceding to that when interest rates were lower at that point in time. And I'm also looking at these rates and thinking, man, these are much higher than we're experiencing today, right? These are higher interest rates and people are still actively buying, actively investing. And that goes to show that we've all been spoiled over the past few years with these historically low interest rates. And now that's become the norm. Anytime we have a slight increase to that, of course, there's going to be some concern about where interest rates are going to go. But big picture here, interest rates between that 5 and 6%, which we're kind of seeing for investment properties right now, because you were talking about even primary residence, not even investment properties, which would be a higher rate. But the main take-home message is that interest rates are still relatively low right now, still relatively affordable for cash flow on a property. And also that does not mean home prices are going to come down. In fact, we've never seen that where interest rates increase a significant amount over a course of a few quarters or a year. But home prices will continue to increase and probably in a lot of these stats you're throwing out have increased more than when interest rates were lower. And that's also going back to showcase that interest rates are a reflection of how the economy is doing. We are experiencing high inflation, and so the Feds may be trying to mitigate that some with increasing interest rates. But this is a natural thing to happen. This is an expected thing to happen. When we have interest rates increasing, it means that the economy is strong and people are buying and they will continue to buy and the economy will still support that. So at no point in history, nor do we think right now that with interest rates increasing, that we're going to see a reduction in home prices. That means do not wait to invest. Invest now still and take advantage of these still relatively low interest rates, but ultimately invest for the fundamentals of real estate. We just released a new calculator on our website, which this is in its kind of beta format. If you go under tools at rentretirement.com, you can see the normal pro forma. Typically, we had a pro forma there. But I spent a lot of time, and I mean a lot of time because I am not tech savvy, but we're getting some software engineers to assist us with this in developing a more effective calculator. But for right now, it's on the spreadsheet. It's a wealth tracker. And the point of this is to allow you to track all the benefits of real estate, just holding it over time. Because when we're looking at appreciation, debt reduction, which happens every single mortgage payment you make, as well as some tax benefits and depreciation, it's okay. Cash flow aside, how am I actually growing my net worth over time and building out that equity position? And the point I'm making is that it's important to still invest in real estate. Interest rates are a reflection of a point in time. Yes, it may limit cash flow, all things considered, that interest rates, I mean, if you're looking at cash flow with 4% versus a 5 or 6%, yes, that means that the mortgage is going to be a little bit higher and a little bit less cash flow. so be it. But that also means, based on the stats that we just went through, that likely that's going to cause rents to increase at a higher rate. We see that in inflationary environments, as well as home prices will continue to appreciate over time. So you're growing your net worth likely better than you were in a low interest rate environment. And that's why it's still important to invest in real estate to ultimately achieve your financial goals, to increase your net worth, to increase your equity position. You can always refinance down the road if that's something that you want to do when interest rates maybe come down or stabilize. Who knows if or when that's going to happen? But I think it's important to not sit on the sidelines here thinking that prices are automatically going to go down because interest rates are higher, especially when you're looking at investment properties, Adam, that are in that median home price point or below, because they're still very affordable. And sometimes maybe that means more people are renting in an instance where maybe they can afford those higher end properties, which I think if there was a property that would be affected by affordability due to higher interest rates, it's going to be your much more expensive, $1 million luxury type houses where, yeah, at one point in interest could mean, hundreds of dollars difference. And so that might push that buyer pool down a notch to the areas where we focus in, which is at or below the median house price point. That's going to allow for more buyers in those. So you had some information that we were discussing previously about how higher interest rates are actually injecting more money into the economy and making a stronger economy. Can you speak on that a little bit?
Yeah, so when you look at the Fed funds rate and all of the bank loans and all the interest that's given on like the 10-year treasury, the 30-year, all of those things, you need to look at it as people are getting the money and the government is spending the money. So the Fed is giving out these rates. The 10-year bond is you getting paid by the government for it. The 30-year is, you're getting paid. The 3-month you're getting paid. As these rates go up, it is actually not costing the banks anything. It's an injection of money to the people. So, if I could go out and get, a bond for, 0% interest, then obviously, I'll go out, I'll put in $20, I'll get $20 back. But then if the Fed says, well, now we're going to give you 0.5% on your money. Yeah, it's 0.5% of $20 isn't a whole lot of money, but it's still more than I had before. So as they increase the rates, they're putting more and more money into the economy, which then drives the economy hotter, which is why, you look at some places around the world, I know people will say it's different because their currency is different. Japan, for example, has been pumping money into the economy and into the economy and into the economy, trying to figure out why they can't get interest rates or why they can't get inflation to come in. And part of that is because they have their interest rates at zero. So things aren't growing as much. And so all of the money they're putting in, it's not continually growing. So as we continue to increase our rates, it just brings more money in. If you look at the actual, balance sheet of the Fed, which you can get, if you're a big time nerd, I looked at it myself. You can go and find the Fed's daily balance sheet, and you look at times when interest rates are high and times that interest rates are low. Now, when I say interest rates this time, I'm talking about on treasuries. And the amount of money they're spending every day when there are high interest rates is significantly greater than whenever they're low. And all of that money is flowing straight into real people's pockets that's then going out into the economy. So you are getting a significant injection of money into the economy whenever rates go up.
So would you go so far as to say that increasing interest rates are a good thing, Adam?
That just depends on what you're trying to do. In this case, I've been telling people, as you look at your interest rates right now and they say, oh, well, the deal looked really good whenever it was at 4.5%, and now it's at 5.25 or 5.5, and it doesn't look quite as good. And really, we've talked and you've said, interest rates just a snapshot in time. And so what I tell people is maybe year one isn't as great as you expected it to be when you first went into the deal. But we're not investing for 1 year. We're investing for 3, 5, 10, 15 years. So if you look at year one, sure, maybe your cash on cash drops down, and let's say you even go all the way down to 5 or 6%, which obviously is not preferred, but let's say it is 5 or 6%. Well, in today's market right now, with what we're seeing, a year from now, you're going to be able to up your rent probably at least 5, 6, 7%. In a lot of markets, it's very good chance it might be double digits, but let's just say you can increase it 5%. Well, then suddenly your return jumps. And as it continues, as prices continue to increase, rents are going to increase like they always do. They follow. And so suddenly your returns year 2, 3, 4, 5, 6, 7, 8, 9 get to where you were expecting them to be, or even start surpassing them. So, maybe in year 1, it's not quite as sexy, but the rest of the years, you're doing really well.
I'm going to throw out a bold statement, Adam, and I want to hear your perspective before I go into kind of my opinion on the matter. But I mean, what if I were to tell you that cash flow doesn't matter? Cash flow in properties really doesn't matter. If you have a higher interest rate and you have a slightly higher mortgage payment, which limits cash flow, on a $200,000 or $100,000 to $200,000 property, maybe you're talking $30-$40 a month. Sure, that makes an impact on a projected return, but I mean, what's your opinion if I were to say cash flow just simply doesn't matter, big picture?
I would say it depends if you're living on it or not. If suddenly every single property you had didn't cash flow and you were break even and you're relying on that for your retirement income, then I would say that I would have to disagree with you. But if you're talking about just you're getting started and you're not horribly concerned about a high cash flow, then in that respect, I can see what you're saying and will agree with it.
Yeah, no, you made some valid points. That's very good. And kind of what I'm getting at is that really how you build net worth in real estate is through all the other ancillary benefits of owning real estate. Cash flow, yes, we want to make sure cash flow is positive. I'm not encouraging anyone to go out and buy a negatively cash flowing property. Don't get me wrong. But over time, what grows, and this is part of the reason we wanted to put this wealth calculator together. I encourage everyone to go on and look at that under the tools tab and play around with it and look at even a negative or break even cash flow scenario, how your equity and net worth grows exponentially and compounds year after year, and rental increases will go up, right? So maybe year 1 cash flow is a minimal amount, maybe it's a 6% cash on cash return, but you're not injecting any more money into that property, but the rents are going up over time, which we see in inflationary environments. But that's really my point, is that your net worth and really where you build a sustainable portfolio and achieve your financial goals and financial freedom at some point in time is through simply owning real estate year after year and adding more properties, because that adds that compounding effect where the properties are going up in value over time. The loan is being paid down. You have the tax benefits and depreciation. Your rents are increasing over time. Again, in a high interest rate, high inflationary environment, which is now what we're seeing ourselves in, that actually drives the economy, shows that there's a strong economy that will drive rents up quicker over time, likely have strong future appreciation, kind of contradictive to what a lot of people think. Prices are likely not going to come down. We're going to see still a future of strong appreciation. So now's the time to get in to actually ride that wave up and build your net worth over time. No one that is investing in real estate, I mean, everyone, especially the newer investor, which we have a lot of, they're so focused and centered around cash flow. And I think it comes from the perspective of, okay, if this property is $300 a door, month 1, how many properties do I need to actually get $10,000 a month and ultimately retire off of your portfolio, right? But the reality is no one is living off of their cash flow right now. This is disposable income that we're investing for a future point in time when we do plan to have this supplemental income that will allow us to retire from our jobs or do something like that. That will increase over time. It's important to track that because rents will go up over time. You're going to be building your equity position. Cash flow day 1, yes, we want it to be positive to pay for the property and provide some residual income right now, but we're not trying to live off of it right now. We're trying to grow our net worth and get a higher percentage on our return on investment through all the other ways of real estate and naturally let those rents go up over time and increase our equity position. So I just always think that's important to kind of look at the big picture and long-term kind of strategy here with how to build a successful portfolio.
Yeah, I remember back towards the beginning of my investment career, I was at a conference and this person was talking about their goals and their journey. And they were saying how, their properties, they wanted to buy properties that average $350 a month cash flow. And I was thinking, we had several properties at that point, and I was like, man, our properties don't cash flow $350 a month. Like, what are they talking about? Where are they getting these properties that cash flow $350 a month? Now that was several years ago. And now I'm at the point where I don't have a single property that cash flows less than $350 a month, because over time the rents have increased, my mortgage payment hasn't increased, and now I'm looking, and 350 is probably the least of it. I have new properties now and old properties now that are cash flowing $700-800 a month on the 20% I put down. And so it's, you can't just look at it as at year one, like we were just talking about. It's over time. You'll hear stories of people talking about their cash flow and think, well, that's ridiculous, that they started investing 10 years ago, so of course their cash flow is higher, prices were lower. Well, yeah, your cash flow is not going to be as good today because you haven't had time. Your time hasn't become your friend yet. Time will become your friend, but it hasn't become your friend yet. And I also want to note, I'll kind of run through the last three instances, but if you listen to what I'm saying, when I was looking at the interest rate chart on the Fed, there are very few times where you saw a sustained rise in interest rates across. This is 30 years at this point, because the first one was in 1993 that I looked at. And so in 30 years, there's really only been 6 instances where for more than 3/4 the interest rates continually rose. It's been on a steady downward trend over time. Now, obviously, when you get to like your 2% rates that we were at, during COVID, probably not going to have too many more down years of that. But even where we are now, I think the 30-year rate for owner occupieds is like 4.3 or 4.4, maybe somewhere in that range. That's lower than every single thing that I have that's before 2006. That's, if you told somebody back in 1990, hey, you can get a 30-year fixed rate for, 4.25, they would have laughed at you, because that wasn't a thing, and it hadn't been a thing, and it would obviously never ever be a thing, because that's just ridiculous. But it is the reality that we're in now. And so, I'm not going to run through the exact numbers, but I'll give you timelines. So interest rates rose from 2005 to 2006. And over that time that they were rising, home prices rose 4.7%. The previous 12 months, obviously this was just before the crash. The previous 12 months, home prices had gone up 8.5%. So it did slow it down, but did not stop, did not drop. From 2012 to 2013, we saw an 8.8% increase, even though rates went up by over a full point. And the previous 12 months, obviously, we were still recovering from the Great Recession, so there were a significant jump of 12%. And then the last time they went up was back in the end of 2016 through actually 2018. There was a steady climb that was about 1.25 points. Then home prices still went up about 3%, whereas before they'd gone up 5.4%. So, over time, in the last 3-4 times that it's happened, well, 3 times, I should say, the 4th time it went up, but the last 3 times it's slowed it down, but it in no way has stopped the increase.
Yeah, and thanks for pointing that out. Just to recap what you said, Adam, out of the past 30 years, the 6 times that we saw an incremental increase in interest rates at some variance of significance, which on average maybe a point, point and a half, whatever, we've still seen strong appreciation. Many of those times, stronger appreciation than the year we saw previously when the interest rates were lower. So that's important to note. I think some people assume that interest rates would lead to a market correction. That's not the case under any circumstances. Interest rates rising are a reflection of a strong economy, supporting a strong economy, which will lead us to likely higher rental increases and appreciation over time, which will further your cash flow and net worth over time. As you mentioned, time can be your biggest asset or your biggest adversary if you sit around and wait. Time is, if you talk to any successful investor, it's like, what would you do, hindsight, if what would you do differently? And usually the unanimous answer is, I wish I got started sooner and was more aggressive earlier on, because time is what builds your portfolio. Not to get sidetracked, going back to this, interest rates are not what cause market corrections, right? We just don't see that. That's not the case. We have some sort of instability, or there's some sort of weird financing picture, like in 2008. Everyone wants to look at 2008 as if that's going to happen again. That was a very unique scenario that was created by the instability of financial institutions offering inappropriate loans. That just doesn't happen today. It's completely different. We cannot even begin to compare 2008 to the position that we're in today. That's likely not going to happen under any circumstances. There's other things that could affect volatility of the real estate market. Interest rates are not one of them. And so going back to this point, I mean, when you have a high inflationary environment where interest rates naturally become higher over time, it's important to have hard assets where those can work towards your advantage to growing net worth over time. I encourage everyone to actually run the numbers out on a calculator. And if you are one of the people that are concerned about interest rates and limiting cash flow, and that's your reason for not investing, put on a pencil, take out a pen and paper and write down your cash flow, your net worth in your real estate portfolio based on appreciation, debt reduction. You need to factor all those things in. You can be conservative and run a 4 or 5% appreciation. You can use our new calculator to do that on the wealth tracker side, which does it for you. Take out your loan deduction, or I'm sorry, your principal pay down on your loan, because there is an amortization scale on there as well that will show you every payment you make, it reduces the amount owed on the property, and take that over a course of a 1-year period and then compare it to not doing anything versus investing in the real estate and growing your net worth, and then look at the different interest rate of how that would affect it. So maybe you say, or let's say you don't invest in the real estate because cash flow might be, instead of being $3,000 annually, it's $1,500 just because the mortgage is higher. But you've also grown your net worth $10,000, $20,000 through appreciation, debt reduction, tax benefits, and that's really what it's about. At the end of the day, it's important to build your portfolio thinking long term and also looking how rents increase over time. So I think that's very important to look at. This was an essential conversation to have.
Yeah, and I think if you want to look at what's going to drive home prices down, or what, historically, you need to see people losing income. I mean, whether that's through massive job loss, which is why we saw real estate kind of pause at the beginning of the pandemic, or, wages dropping or something to that effect. And that is simply not what's going on right now. People are seeing, raises for the first time in a long time. Wages are very sticky when it comes to workers. They're not going to go back and say, hey, we raised your wage $3, $3 an hour during the pandemic, but now we're going to cut you back those $3 and you'll be happy and you'll stick around. It doesn't happen. Wages are very sticky. And until we see a time where our economy completely changes, people lose their jobs, people are running into, we're having to do more foreclosures and stuff to that effect, you're not going to see the drop in the market come. And nothing that we're seeing is suggesting that we're reaching that point. So it's like I've said 100 times, and I'll say it 100 times in the future. You invest for the fundamentals and you don't change your strategy until the fundamentals change. And the fundamentals haven't changed. I mean, we still have a very strong economy. Yes, we have inflation, but we have a very robust economy. The unemployment rate is back down to where it was pre-pandemic. Supply lines have opened up some. They are continuing to get better and better. The world is pretty much saying we're not going to shut down again. Obviously, some countries are still a little more leery than others. But at this point in time, things are on the rebound, looking up. And, until something else comes along that shakes your faith in the overall, market and society and US, then we're looking at a strong growth for real estate for that future.
Don't wait to invest in real estate. Invest in real estate and wait, right? Let time be your biggest, partner in investing in real estate, growing your net worth over time. It's the slow game, but it takes consistency over time. Interest rate is just a metric, right? It's just a number to look at. And yes, it affects potential cash flow. Most people are not going to hold that loan for 30 years in place anyways. So the average holding time that we see is probably between 3 to 6 years on average, because that's a time point where, okay, you've had a property, it's appreciated, you paid the debt down. Yes, rents have gone up a little bit. Maybe it makes more sense to sell and 1031 that property before you have, some capital expenditures that might come up on that over that time. So it's kind of this optimal holding period, and also a strategic time to 1031 to scale your portfolio. So that being considered, when you look at a 30-year holding time frame for a 1% difference in interest rate, that's a lot of difference in interest. But the likelihood of you actually holding that loan for 30 years is very unlikely. So look at it over a 5-year period and look at where your cash flow is. But it's important to know that rents go up over time in these inflationary environments, and so do home prices. And that's really the point we're trying to hit home with people. If anyone hasn't listened to the other show that we did where you talked about market corrections and rents going up during market corrections as well. Again, this is separate because we're not talking about a market correction as interest rates are increasing. But that's an important thing to look at as well, right? I think, statistically over the past 30 plus years, you'd be able to talk about these stats more, Adam. But when we do see some sort of market correction, which we're not alluding to, people have been asking about, when are we going to have a housing bubble or market correction for probably 7 or 8 years now? And this has been a talk forever, but there's really nothing that's really pointing to that. Again, that markets are cyclical, and I think this is important, why it's important to invest in the path of progress in areas that have strong, diversified economies, in markets that have, population growth dramatically, especially in areas like Texas and Florida and some of these markets on the Sun Belt, areas that have a housing shortage. We are at I believe, all-time low for housing availability and all-time high for demand. So supply and demand, that's really the most important thing to look at, especially on a microeconomic scale when you're choosing to invest. If you're investing in the path of progress, you will be just fine. That's important. Why it's important to do market analysis. We already do that and choose strategically the markets that we personally invest in and offer investment opportunities for people. So throw us out some stats on the housing shortage, because we did another podcast about that. Do you remember what those stats look like?
The most recent housing shortage number that came out was 5.3 million. In the last decade, there were 12.3 million new households, and there were 7 million homes built. So we saw a 5.3 million deficit in homes over the last decade.
Yeah, so simple supply and demand, especially when you're in that median or below home price point, that's where you want to be, So lots of good stuff covered, Adam. I think end of the day, don't let interest rates influence your investing decision. Invest for the fundamentals. Still, I get it. You got to make the cash flow work, but over time, cash flow will increase, but so will your net worth through appreciation, debt reduction, tax benefits. That's really how people build generational wealth in real estate.
Absolutely. So thanks everybody for listening to this episode. Feel free to go back and check out all of our other episodes. You can find that on your podcast platform, as well as on the Rent to Retirement website where we have our podcasts. Check out our website. You can see our inventory. You can check out the calculator Zach was mentioning earlier in the tools section. You can schedule a call with one of our investment strategists to talk about how we can help you with your portfolio. That's all at renttoretirement.com. We really appreciate you taking the time to listen. Don't forget to subscribe to the show. Please leave us a review on the podcast platform so we can see if we're serving you like we need. And if you have any questions, send them to podcast@renttoretirement.com. That's podcast@renttoretirement.com. And we'll see you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.